Okay, we're going to have a look at monopolistic competition. So I think the most important thing to bear in mind about monopolistic competition is what it isn't. It is not monopoly. So in monopoly, you have just one firm. By definition. Whereas in monopolistic competition, actually, it's a market structure that's closest to perfect competition. And it's actually based on the assumptions of perfect competition. The neoclassical economists, they took the assumptions of perfect competition and they changed some of them to make the model a little more real world. So if we think about what are the assumptions of perfect competition, then we know that in perfect competition, for example, we've got many buyers and sellers. Well, that's okay. It's relatively realistic. There are plenty of markets where there are many buyers and sellers, so they kept that one. And they also wanted the idea that the market was going to be fully contestable, that there were going to be no barriers to entry and exit. Again, because it was looking for a competitive market, they were trying to differentiate it from monopoly, where there are big barriers to entry, so they kept that one. What they changed was, in perfect competition, we know that, they're identical products, or homogeneous products, if you prefer. What they said is, well, we don't want that. We're not going to have that anymore. We want something that's a bit more real world. So what we have is we have differentiated products. So these products, they're fairly similar to one another, but they're not identical. So we're thinking about things like taxis, restaurants, hairdressers, that type of stuff, where basically they're providing the same thing, but there are slight differences between the products and the goods and services that are offered. And the final assumption of perfect competition that's relevant here is perfect knowledge. And again, that's a bit unrealistic. The idea that everybody knows everything about the price and quality of everything in the market. So they said, we're not going to have that. But on the other hand, we're not going to have clueless customers. So although there's some degree of information asymmetry, we're going to have good but not perfect knowledge. Now, the consequence of that is that in perfect competition, because of the assumptions, demand was horizontal, because it meant that if you increase price, demand would fall immediately to zero. Whereas in monopolistic competition, if you increase price, sure, so suppose you're an Indian restaurant on the Cali Road or something. Yes, if you increase price, sure, you're going to lose a lot of customers, but you're not going to lose them all. So demand will be elastic, but not completely so. So your demand average revenue line, price line, is downward sloping. Now, for reasons that we're not going to get into here, if you have a downward sloping demand line, then marginal revenue is twice as steep as that. And it's simply mathematically true. If you're interested, I can make a video explaining that. Take me 2 or 3 minutes, but it's not of great significance here. What that means, though, is that the diagrams now, because MR and AR are different, the diagrams work slightly differently to those of perfect competition. In all market structures, we're going to assume that firms are profit maximizers, and that therefore they're going to want to produce where MC equals MR. And as we said elsewhere, that's always stage one. So in any of these diagrams, stage one is the marginal stage, where you identify the profit maximizing output, Q star. Then at that output, you then say, how much is total revenue? How much is total cost? To do that, you have to take Q star, and for total revenue, you multiply by average revenue. For total cost, you multiply by average cost. So let's do that. Let's suppose that we've got a firm in monopolistic competition that's making abnormal profit. Now, that's not really a sustainable situation for a firm in monopolistic competition, because we know that in the long run, new firms can enter the market. And if there are significant amounts of profit being made, then they will almost certainly do so. But if we talk through how to do the diagram, as we say, it's a two-stage process. Stage one is we simply find where MC equals MR here. Call that Q star. Then at that output, we say, well, the price the firm can charge is determined by average revenue. So the brown box is total revenue. We then say, well, how much it costs? What we know is that average cost is the cost per unit. We're making that number of units, so your unit cost is C1. So the pink area down at the bottom is costs, and therefore the purpley area up here is profit, abnormal profit, because it's the gap between total revenue and total cost. So that's the firm that's making abnormal profits. That can only really be true in the short run, because in the long run what's going to happen is that new firms will enter. And they can do that because there are no barriers to entry. there are no barriers to entry into the market. Yeah, so new firms can break in. As a result of which, the consequence is that for existing firms, yeah, so like the one that I've drawn above, they start to lose market share. In other words, demand starts to fall for those. Demand starts to fall for those firms. So, if I was doing this in an exam, and the way I do it is actually I do it as a kind of three-stage process. Yeah, so I draw the abnormal profit, then I'd show that's my initial demand and average revenue. Yeah, I'd then say, so what happens is that demand and average revenue and margin revenue, they start to shift in. And they'll continue shifting in, like in perfect competition, until only normal profits can be earned. Because at that point, there's no point in entering the market. Yeah, you can earn normal profits where you are already, and if you were to enter this market, then all you would do is end up driving price below the point at which anybody can make any profit at all. You know, we'd have subnormal profits. So we end up in monopolistic competition in the long run, yeah, in a situation like this. MC equals MR is at Q1, yeah, and then the firm can make only normal profit. Yeah, average cost and average revenue are the same at the profit maximising output. So even though the firm is making as much profit as it possibly can, it's still only making normal profits. So do we like monopolistic competition? Well, it depends. If we look at efficiency, probably not that much. Yeah, it's clearly not productively efficient, as we said the other day. Yeah, it's not producing the minimum point of its average cost curve. Costs could have been as low as CPE, but they're not. So therefore, that distance represents the waste per unit. We're using more resources than we need to. Likewise, we're not producing, if you remember, demand is marginal utility. We're not producing at the point at which marginal utility equals marginal cost there, the allocatively efficient output. So although we are generating welfare, these units have marginal utility greater than marginal cost. We're not maximising welfare. We're not going all the way to the socially efficient point. And therefore this yellow area, if you can see that, I hope you can, this yellow area is our welfare loss as a result of being allocatively inefficient. And also, we're not going to be dynamically efficient either because we don't have any abnormal profits in the long term. So the only real efficiency that's likely in monopolistic competition is X efficiency. You know, they're not going to have, because they face quite a lot of competition and contestability, they can't really waste resources. From a consumer point of view, maybe things are a bit better on the basis that, at least you have some choice. Not everything is the same. You can have something that's more tailored to what it is that you want. Prices are going to be relatively low, although not as low as in perfect competition, but probably better than monopoly. But the lack of dynamic efficiency and also the lack of economies of scale, could create difficulties. On the other hand, a lot will depend on what sort of market we're in. I mean, so in markets where there aren't economies of scale, monopolistic competition may well be your best choice because, choice of market structure, because consumers do have lots of choice of a wide variety of products. And if you look down at the bottom of the OneNote, you'll see an essay that's looking at the extent to which perfect competition and monopolistic competition are relatively desirable. If you have a look at the mark scheme there, then that'll give you some more ideas on this particular market structure.